This is going to be a fun video. My last video, I sold 2 stocks. We'll cover those. Now I sold 2 more, but then I bought 2 with all those funds because I really want to focus my money in certain areas, reconstruct my portfolio so that way it's solid, it's going to provide me the growth that I want and be reliable. So I'm setting myself up for future wealth, and you're going to see exactly what I'm doing, all the change. This is going to be a good video. So what I want to start with is let's look at originally where my portfolio sat. So you'll see here, this is how it used to look, but I sold 2 companies. And if you watched last video, you know that it was 3M, which is an industrial stock, and Johnson & Johnson. Now 3M surprisingly had really good earnings and a good forecast, and it shot this stock up massively. I thought I would never sell this stock in the green, but I got to sell it break even. I thought I better take this chance now before something happens, because this company is at risk with litigation constantly because of the products it makes, the way it pollutes the environment and people's bodies. I think it's going to be forever issue with this company. Plus, this company has high CapEx. Also, they do not provide products that customers continuously buy. So they're repurchasing almost like a subscription, you could think of it. That doesn't happen. I rarely buy 3M products. I do have them, right? We all have 3M products, but how often do we buy them? So I just don't see this company as a good long-term play. Even if in the short term it has a good couple years, I think that will end, and then investors will be back in the seat of losses. So I sold 3M. I'm so happy I got out of this company. I just think it's a dog of a company. It's a trap. Long term, yes, they can improve some, but again, I do not think they're going to be a long-term winner. Then I sold Johnson & Johnson. This one I sold in the green. I think that Johnson & Johnson is a great company overall, but I mentioned that a few things. I mentioned that I am not comfortable investing in a company I don't really know much about. So pharmaceuticals is not my area of expertise. So therefore, I felt like that kind of puts up a barrier for me really investing in a company and knowing its future, what it's doing. I kind of am blind here. So I decided to sell for that reason, as well as they are one of only 2 companies that are AAA rated in the stock market. The other one is Microsoft, and I think Johnson & Johnson is at risk of losing that rating. And I went over that in the last video, but basically this company does have a negative outlook with its rating, which means it can be reduced. So I just thought I better get out now. They also have a lot of risks with the products, the pharmaceuticals that they put out. If something goes wrong, there's tons of lawsuits that can and probably will happen. Another lawsuit heavy company, I think, just like 3M. So I wanted out of that. I broke free. I sold those 2. And then if we go down here, this is what my portfolio looked like after I sold those 2. And I also sold an additional 2 stocks. So which ones did I sell? Well, I'm going to start with Cisco. Now, Cisco, they sell a lot of hardware. They have been trying really hard to move to subscription-based services, but they're struggling. It's a slow pace. They're moving at a turtle's pace, and they just can't seem to break out and grow. So I don't think this company will be an Intel, but I don't think it'll be a Microsoft either. I just think it'll be a mediocre investment, and that's not what I want. I don't want mediocre. I want stocks that are high quality and that shine brightly with their future. And Cisco is not that stock. The other company I sold, and this one I'm so happy to get rid of, AT&T. This company shot up this morning up to near $20 per share. That's when I sold it, and then it dropped right after. That's what AT&T likes to do. They like to drop. Their stock likes to go down. It's just what this company does. Now this company, it's a high capital expenditure company. I mean, they got to invest a lot in 5G and fiber investments as well as network equipment. That'll be a forever thing. They're always going to have these high expenses. And this company has enormous debt, over $120 some billion in debt. They are paying it down, but again, at a turtle's pace. I expected this company, I had the expectations that they would pay it down faster because management really came out a few years ago and said, we are hyper-focused on paying down this debt, and it's a snail's pace. So at least they're paying it down, but not fast enough. I think this company will always hold a high level of debt. It is a trap as well, in my opinion, just like 3M, but even worse. I think this will just continue to lose investors' money, and it's one that I am so happy to get rid of. I had the opportunity. I sold, and between selling AT&T, I did sell at a slight loss, only like $100, but then I sold Cisco at near $200 in profit. So I made money today selling. So those are the 4 stocks I sold. So now, after selling those 4 stocks, this is what my portfolio looks like. This is the much improved portfolio. This is one that's set up for growth, for success. And you'll see here that there's one new investment. And I don't know if you can spot it easily. I did reorganize this a little bit, but you'll see in the very upper left-hand corner, I have my dividend ETF SCHD. I thought a good complement would be the growth ETF equivalent, which is SCHG. Now, I've always wanted to do this, right? A long time ago when I first started investing, I invested in more of a dividend growth focused mindset strategy. But realizing that I'm still relatively young, I want to focus more on growth. I want to have both, right? But I want to focus more heavily on growth now and then transition slowly as I get older and older more towards that dividend growth strategy. So what I've always wanted is a dividend growth ETF and a solid growth ETF, and now I have that. And I eventually want them both to make up 50%, maybe 40%, but between 40 and 50% of this portfolio. So each about between 20 to 25% allocation. In purple are the allocations. So SCHD is at 13%, SCHG is at 5%. So I'm going to be building these up, and then the other 50 to 60% of my portfolio will be in individual stocks that I have high convictions on. And I will say, I also did not mention this, but I did buy, with my funds, additional shares in Amazon because they just reported they had kind of a weak sales forecast. So, of course, to me, their earnings look great. They're growing in all areas. Their cloud is doing excellent. And so because of the emotions of investors, I think this company was way oversold. I still think it's undervalued. So I put some more weight into this, and it now holds a 12.24% allocation in my portfolio. I also put some money into health equity. This is one I'll make several videos of in the future because it's a company that not a lot of people know, not a lot of investors know about it, but I'm really bullish on it. So I added some because it did drop. Now, the reason why it dropped, I could not find it, but this stock has been volatile because it is a smaller company. It's more of a speculative play, but it has great, solid financials. In fact, all the metrics are going in the right direction, as you can see here, but I'll talk more about it later. But yes, Amazon, I bulked up. Health equity, I bulked up. And I will say this, I don't want to say the company right now, but there's another technology company I'm kind of interested in. So you might see that pop up someday. But this is going to be the portfolio for a while. And there's only one weak investment on this portfolio now that I want to get rid of. I got rid of the other 4, but the other one I'm really wanting to get rid of is Warner Bros. Discovery. But I'm very confident I can sell in the green. I think this company is massively undervalued. I think that it has still great potential, and some solid earnings from this company will send the stock rocketing up. In fact, analysts show this stock at about 40% undervalued. I think that this one is a good speculative play. So I haven't sold yet. It has gone up over the last 3 to 6 months, and I think it's going to continue in that trajectory. And eventually I'll be able to sell in the green, and then I can help, bulk up where I need to with my planned portfolio here and having the ETFs at a higher percentage, and then also really focusing on those individual stocks that I feel are going to help me outperform. This is an outperforming portfolio I am building. So lots of change. I know that I didn't expect this much change, but just things fell into place, right? 3M shot up, AT&T's been doing really good, and then Cisco and Johnson & Johnson, I was still holding in the green, so I thought might as well sell them. And then because of the dip we had with a lot of the technology stocks, which affected SCHG, it fell some. So I decided to open the position, and I'll be adding to this over time. And I don't care if this goes into the red, because I realize a lot of you might say that technology stocks are overvalued, which this has a high weight of. I'll show you a little bit more details on SCHG here in a second. But I'm okay with that because in the long term, I think technology still has an amazing future over the next couple decades. And even if not, that's the benefit of holding an ETF that's passively managed. It will switch out the bad investments for good investments based on the calculations that it has in its fund. So regardless, I am fine holding this. If it goes into the red for a while, great, I get to add more. That's always my stance with the stocks that I know are high quality, or the ETFs, and that I've researched on. And so if they go in the red for a while, perfect, let me add. So yes, this portfolio is now my outperformance setup for the future. And let's talk about that new growth ETF, SCHG. So what I love about this ETF, it has an extremely low expense ratio, one of the lowest out there at 0.04%. You will see some other ETFs out there with 0.4, not 0.04, but 0.4%. And those expense ratios can cut in fact, they will cut in to your profits long term, especially the higher they are, really limits what you could have made if you just invested in the individual companies in that fund in the first place. So 0.04, thumbs up for me. Of course, the objective is that it tracks as closely as possible the total return of the Dow Jones US Large Cap Growth Stock Market Index. Now, some highlights I just want to point out too here is this gives you simple access to large cap US equities that exhibit growth style characteristics. And this fund, like all funds, it holds stocks that are classified as growth based on a number of factors. Factors being, calculations and certain requirements in order to get into this ETF. Now, this fund has 251 total holdings, so I feel that's a good amount. Some ETFs have thousands of companies, and this one has 251, so I like that. It's not so watered down. It's got a good amount of holdings, in my opinion. And then it's, of course, passively managed. It does pay a dividend, yes, but it is small at about 0.4%, but I'll take that. And over time, of course, that will grow as the stock appreciates. Now let's talk about its performance. This is one reason why I'm very bullish. You'll look at the annualized returns. Now, since inception, it gives you 16.39% growth every year. Over the last 10 years, the average annualized returns is about the same, 16.28. And then 5 years was 20.04, so it went up. The last 3 years was 11.93, so it kind of underperformed. But this last year is really making up for it at 35.15% growth. That's phenomenal. And of course, that won't repeat very often, but at least I know on the average I'm getting between 16 and 17% returns in the long term. And of course, on the years that underperform, I'll add more. And those years that are above average of these annualized returns, I'll add less. But really long term, I just want that 16% average. That will help me help provide me great wealth investing in this fund heavily. So then if we look at the top 10, this is very exciting and important to see because it aligns with my portfolio in a way, right? One stock I don't hold is Apple. So this gives me some exposure to Apple, and it's their top holding at almost near 12%. In fact, I circled the top 3 there. They make up a big chunk of this fund. Then you have Microsoft, which I'm very bullish on, and I'm fine getting more Microsoft. In fact, I don't think I can get enough of it. Of course, I don't want to overweight it, but this is a great way to do so. Nvidia, I don't have that. I do think this stock is overvalued and it has some risks with its valuation, but hey, I'm getting some exposure to it. Then, of course, Amazon, another stock I'm very bullish on. It's the one that I hold in my portfolio, so give me more of it. I'm fine with that. Then you have Meta and Google, which I don't hold, but I do really like both companies, especially Google. And maybe someday I might add that. That's not the stock I was thinking of for my technology pick, but it's one I would consider. And then you have, of course, Eli Lilly. You have Broadcom and Tesla. Now, Tesla, to me, I think its big days of growth are behind it, but I think there's a chance that, here and there, it will provide some bursts of performance. But for me, it wouldn't be one I would hold individually. Now, if we look at the sector information, of course, it's very heavy in the information technology sector, which I said does pose some risk, right? If this sector underperforms, but I really think this sector still has many years and decades of outperformance. So I like to see this. Communication services is pretty high up there, consumer discretionary, and then healthcare, and then financials. And then it drops off pretty heavily after that. Industrials is typically a very slow growing industry. Consumer staples as well, right? That's where you want to be protected. So you're going to have stocks that aren't really as volatile. So the growth will be not as much or have as much opportunity as, say, the IT sector. Materials, of course, is a low growing sector as well as utilities. Real estate is low, so I'm happy about that because I have two companies, which is Realty Income and Vici. I'm very bullish on, have a high allocation. In fact, SEHD, the dividend one, has no real estate in it, and this one has very minimal. So the fact that I'm heavily invested in two individual stocks makes up for that and gives me that exposure on that end on two companies I'm very bullish on. And then energy is a low allocation. I actually am bullish on energy. I have an ETF in my portfolio, FENY, which I'd love to add more to. But since I'm up 80% in it, it's kind of hard. You kind of get the mind games of adding when you have that big of gains. But I do think energy is here to stay. There's a huge future potential for growth in the future. So I think now that you have seen the change that I have done, this is what we all need to do, right? We need to continuously analyze our portfolio because I think some people forget to invest or forget to really look at their companies. And that's part of the responsibility of being an investor, is making sure that you constantly analyze every single one of your holdings. So when I see individuals that have, dozens, if not over 100 individual stocks in their portfolio, how on earth can you possibly look at each one, analyze them, and keep track of it? You can't. In fact, I even think, more than 15 is too much. So what I'm doing is I'm putting that burden on those ETFs mainly, right? They're going to make up 40 to 50% of my portfolio. And then I'll have a handful of stocks. No more than 10 is my goal. So between 5 and 10 individual stocks I'm very bullish on, that those are the ones that I spend the time on analyzing, really learning about them, and being able to strategically invest in them and provide me hopefully some really good gains in the future. So that's my plan. Of course, I have a strategy. I invest in quality stocks. If you haven't seen this, this is my quality checklist. And anytime I buy an individual company, it has to check all these boxes. If it checks maybe all of them except for one, there might be some exceptions for me if it's really strong and I think there could be a turnaround in that area. But you have to create your own quality checklist. You have to create your own investing strategy. Right now, I'm about 80% on the growth investing and 20% on the dividend growth investing. And of course, over time, it'll transition more towards a dividend growth investment. But I think that's the best combination for me for my age. So you really have to think of yourself, your situation, your age, your risk tolerance. There's a lot to look into, but also be honest with yourself. If you're not one that will be disciplined to really follow the individual stocks you invest in ETFs. There's two ETFs I invest in that I think are excellent and would be good choices for you, ones to consider. But if you can spend that time, also be realistic with yourself and don't go and invest in 20 plus individual stocks. Make sure you're a person that can sit down and analyze what time you can put towards your portfolio and then estimate how many stocks maybe you can handle, because you want to be looking at earnings every time they release it. You want to constantly be following the stock, looking at what its future plans are, the innovation that this company is investing in. There's so many things to look at. That's why I think that a lot of investors hold too many stocks, and that's where they get in trouble, because then they cannot possibly analyze them all. And there's going to be stocks that start moving in the wrong direction, and you're going to be blindsided because you just didn't know. You didn't have the time to look at it. So this is my plan. I did a lot of buying and selling. So let me know if you've done any kind of sales lately or buys, because I think that's good to share with each other and why. So I told you about my sales and buys and why I did so and my kind of my path for my portfolio. So if you are subscribed to this channel, I am showing you my journey towards wealth, and I'm going to be sharing the good, the bad. I'm honest, I'm transparent. That's how you learn best, and that's how I learn best, because we cannot claim to know it all, and we cannot also just follow those channels that are always talking positively or just cherry picking what they show you. I will show you it all. My failures, my successes, all my stocks, all my buys, all my sells. So I would appreciate it if you would consider subscribing to my channel. And with that said, we'll see you very soon on Mark Arnold's Finance. Have a good day.